Hello, I'm Rohan.
I'm Daniela. In this video, we'll break down a crucial part of a functioning modern economy: capital markets.
In order to understand what capital markets are, let's start by breaking the words up. For most of us, the word capital is represented by money, but it could also include other assets that are held by a person or organization.
Now, let's talk about markets. When you hear the word market, you probably think of a grocery store or perhaps online shopping, where products and services are bought and sold between buyers and sellers. Now, putting the words together, we can define capital markets as financial markets where investment products such as stocks, bonds, currencies, and other financial assets are channeled between buyers and sellers.
As we will shortly discuss, capital markets include the stock market and the bond market. They help people with ideas for a business to become entrepreneurs and also help existing companies grow. In addition, they give individuals like you and me the opportunity to save and invest for our futures.
Capital markets are divided into two main categories: the primary market and the secondary market. When a company publicly sells new stocks or bonds for the first time, such as in an initial public offering or IPO, it does so in the primary capital market. The secondary market is where existing securities are traded among investors. This is most likely the market you see and hear about on the news, such as the Toronto Stock Exchange in Canada or the New York Stock Exchange in the US.
Naturally, you may be wondering what sort of investment products are bought and sold through these primary and secondary markets. While there are many securities to choose from, capital markets feature two main types of securities: equity securities and debt securities. Equity securities, which are also referred to as stocks, are traded on the stock market or stock exchange and are essentially ownership shares of a business or venture.
Debt securities, which are also referred to as bonds, are traded on the bond market. They essentially represent money that you will loan to a company.
Think of it like this. Investors have money that they would like to invest, hoping for it to grow, and companies need capital to run and expand their business. Stocks and bonds are purchased on the primary or secondary market. The company that issues the securities receives the money to finance operations and other initiatives. Without stock and bond markets, business owners would have fewer options to start a company or to expand their business.
Let's give you an example. Meet Sam. Sam is a social media influencer with a few million followers who has an idea for a new business called Active Threads, a custom tracksuit company. Sam has saved his money in the bank, earned interest, and used that to start his business. He has been selling tracksuits through his social media page, and boom, they are a hit. Sam has seen his orders grow exponentially, and now a large sportswear retailer wants to do a collaboration with Active Threads.
Sam now needs to purchase a facility and machinery to produce all the tracksuits and needs to hire people to help him produce, sell, and deliver the final products. There's just one small problem. Sam doesn't have the money to pay for all of this right now. This is where capital markets come in.
Sam has various types of funding that are available to him, but first he must consider what combination of debt and equity he will use to finance the operations and growth of Active Threads. This is known as the company's capital structure. Specifically, the capital structure of a company refers to the composition of its long-term funding sources, including common and preferred stock, bonds, and etc. A company's capital structure is important because it can affect its ability to obtain financing as well as its overall financial health and performance.
Now that Sam has considered the capital structure of his company, he can think about the various ways to obtain funding in equity and bond markets. In the equity markets, Sam can take Active Threads public through an IPO or initial public offering. Unlike a loan, which Sam would have to repay, issuing an IPO will allow investors, like his followers, to buy a share of Sam's company and become partial owners.
As we previously mentioned, a company's capital structure can also consist of debt, so Sam may also issue bonds instead of stocks. This way, Sam will essentially obtain a loan from investors, which he will have to repay at a later date, in addition to making regular interest payments to the bondholders.
Now, say Sam wants his company to remain private. He can obtain the capital needed from private equity firms. Private equity refers to a type of investment in which wealthy investors pool their money together to buy ownership in private companies with the goal of generating a high rate of return on their investment. One of the key characteristics of private equity investments is that they are not traded on public stock exchanges, like the shares of publicly traded companies. This means that private equity investments are typically less liquid than public stocks. Or in other words, they can be more difficult to buy and sell.
The bottom line is that capital markets provide the essential funding to help entrepreneurs like Sam to start a business or expand a current one. And they also provide investment opportunities for people like you to plan for your future. Companies can raise the financial capital they need to grow by issuing equity and debt securities while simultaneously taking advantage of reduced risk and expenses associated with obtaining funding in stock and bond markets.
So, whether you'll have an innovative business idea one day or are looking to invest in your future goals right now, capital markets will be there to gear you up.
Hopefully, this video has been another helpful step for you in your education on investment.
Make sure to continue following along with our videos to learn more about investing.
Thanks for watching. Keep chasing those money gains.